we're going to talk about 3 essential syndicate skills. These are specific to the angel network or syndicate deal-by-deal investing. The first one is the deal process. If you think about the way a syndicate operates, we almost have the opposite process flow from a VC fund. So a VC fund, when they're raising a fund, they will spend a chunk of time, 2.5, 3 years out fundraising for the fund. They are getting capital commitments from investors in order to deploy. They need to do that before they go out to market. And then they start doing deals. When they want to pull the trigger on a deal or they need management fee, they'll take capital calls. They'll make capital calls to the investors to take that capital. With a fund, prolonged fundraising period up front, then you're able to command that capital when you do that deals and you progress that way. With a syndicate, it's almost a little bit opposite. We start with our deal sourcing, diligence cycle until we decide which deals that we want to do. And then the fundraising process is deal by deal. So in a way, you are fundraising for every single deal, but only after we do diligence. So some common mistakes with this deal process for syndicates, right? So high-level pointers, things that I think you should avoid. One is this instinct that you need deal flow before you have investors, before you start building your investors network. The instinct here is that, hey, it's hard to convince investors before I have a deal. And so I need to have this deal, and then I go out to investors and build the base. Why I disagree with it. One is like erosion of trust. It basically means that on your very first touch point with any investor, it's, I've got a deal, let me tell you about it. It can feel a bit salesy, which I personally prefer not to. Second, it's depression. If you already have a deal, it means that the clock is ticking. You have a funding deadline to hit for the startup. Let's say it's 1 month. Meanwhile, every investor interaction you go into, you need to do the education piece of what you do, what your syndicate is about, what your economics are, plus pitch the deal at the same time. So the challenge is against you. Second is information overload. Some groups, when you're publishing a deal, you get this wall of information up front. For instance, a deal memo or a full prospectus right at the very start. Why is it a mistake? You're effectively asking investors to put a lot of time and attention to a deal they know nothing about. Think about it. It might be a 15, 20, or half a minute exercise to ask somebody to sit down to invest the time on something that they don't know and therefore don't care about. So this mindshare investment you're asking from investors, if you take this approach, is too expensive. The engagement principle for nurturing interest is this. You want to drip feed information, give the minimum amount of information for the particular phase, develop the interest, and as they get more engaged, share more, right? You can then, as investors get more engaged, you can basically ask for more time. And so we nurture interest that way. Another tactical mistake, I think, is founder calls at the start. So some groups will organize founder calls where they'll invite their entire investor network, say, hey, I'm organized, I found this company, I think it's really interesting, and I'm just going to share this with you. You're invited to join. And the idea is to be able to nurture interest for the deal at the start of the process with the idea that, hey, you know what? Having a founder come on to pitch is compelling and interesting. It's a way of engaging people. I don't disagree, but I also think it's not optimal. Basically, at the start of a deal cycle, before anybody knows anything about the company, you're asking for a 1-hour founder call, which is a 1-hour time commitment from potential investors on a startup they know nothing about. I feel it's a pretty big ask. Next, you are in a situation where investors know nothing about the company and they might not be interested in the first place. So you're ending up in a call forum. The call can go badly if you have somebody, 1 or 2 people who are negative about the deal, and it ends up being counterproductive for you. And I would also argue that if you can ask for that founder call one time, save it for the end, save it for your pipeline that is qualified and investors are engaged. They know about the company. They are 70% of the way there. Then you use the founder call. You use this as a forcing function to nudge investors over the line. Because I'm saying, hey, you know what? You know about the company. I've organized this founder call in case you want to ask questions. After this, you have a legitimate reason to ask for commitments, right? And this is the way that we close off that funding cycle. The deal cycle is this, right? When you're doing a deal as a syndicate, you don't want to be in open-ended fundraisings where it's open for months and months on end and you have no target date for closing it up. It's not good for the company. It's not good for you. It's not good for anybody. Broadly speaking, I target a 4 to 6 week deal timeline from launching a deal to closing capital and to be able to move on. And I break this process down into 3 layers. The first part is the deal flow part. So here we get deal flow. We qualify deals very quickly and to drop things from pipeline. Then we go into a formal diligence phase to get conviction on the deal. And as we do, we will assemble a data room and write a deal memo. After this, we go into the marketing phase, right? Or the fundraising phase. This is steps 5 to 9 in these orange boxes. The first step of this is obviously publishing the deal. Investors need to know about this. It's good to pre-plan these activations, right? I think of these almost like marketing events. The magic number is 3. Investors need to hear about a deal 3 times before you maximize interest. You go back number 4, 5, 6, you get marginal returns. It's not worth the effort. It starts to look a bit naggy. Investors start to get switched on. If they haven't reacted after 3 times hearing about the deal, they're very unlikely to, okay? So step number 5, which is the first marketing event, is just letting investors know about the deal. I pre-plan a couple of things. An obvious one that you can do is another activation where you let investors know about your investment memo. You say, hey, I formally completed diligence. I've written an investment memo. It's in the data room. I just wanted to let you know. That gives them another reason to go back to the deal. And then the next activation is the founder call. We say, hey, I'm organizing an investor call for you to meet the founder so you can ask questions directly. Then we actually have it, which is step number 9. After the founder call, I use this as a forcing function. After this, I'm asking investors for capital commitments. After the call, within 24 hours, I send a recording. I send the slides from the session to investors. And it's also a reason for me to say, hey, here's the investor call in case you missed it. You might want to watch the recording. By the way, I'm accepting capital now. It's open. Please let me know. And so it's a very natural progression that way. From here, we go into the administration phase, which is starting up our SPV, creating that, following up with investors, doing capital calls, getting all of that capital into the SPV, closing the deal, and doing all the administration functions, right? Things like pro rata rights, carry sharing, any of that. So this is the 14-step deal lifecycle. How do you do defined timeline fundraisers and not of 4 to 6 weeks and not have this drag out into months and months? Now, when we look at this process, the next thing we are going to talk about is step 5 here, which is publishing the deal. You'll see in session 3, when I show the numbers and metrics, why this is a really crucial piece of the puzzle, right? It's important for the metrics and the success of the deal.